Undermine your 709. My name is Matthew Blottmacher, President and CEO of Peak Trust Company. For those that may not know, Peak Trust Company is for advisors looking for a professional trustee who want reliable and accessible expertise to help them with their clients' trust planning needs. Peak Trust Company offers experience and sophistication to help you quickly and accurately establish trusts, backed by easy-to-use ongoing trust administration. Unlike traditional banks or trust companies, at Peak Trust Company, your trust is truly our core business. We provide a highly customized delivery process tailored to your specific needs in an unbundled service structure. Before I get started, just want to take care of a few housekeeping items. Today's presentation is being recorded, and we'll provide recording and any of the slides and materials to all attendees after the presentation is concluded. For questions, there's a Q&A tab or button that you can click and respond there. Either if it's a simple question, we'll either stop the presentation and answer that immediately, or might do that through text, or otherwise we'll leave all questions to the end and we'll get through as many as possible. Today, we're honored to be joined by Beth Shapiro from Kaplin Drysdale's Washington, D.C. office. She rejoined the firm's private client group after 2001 and working for over 6 years with the Treasury Department in their Office of Tax Policy, serving first as attorney advisor and then as associate tax legislative counsel. Ms. Kaufman has the principal responsibility for all tax policy matters affecting trusts and estates, including gifts, estates, generation, transfer taxes, as well as income taxation of trusts and estates. She's continued her focus in these areas in private practice and is here to share her insights with us. Beth, honored to have you with us. Thank you again.
Thank you. And nice of all of you to invite me into your basement or your attic or your closet or wherever you're working from today. Or even your office, maybe, in some parts of the country. So I put together this presentation because I see a lot of gift tax returns in my practice. I like my clients to show me their gift tax returns before they're filed so I can make sure that they accurately reflect the planning that we've done. Also, I often get called in to help people who have mistakes and need to review all their back gift tax returns in order to figure out what's gone wrong and how we can fix it. And then often when we get in a new estate, we're trying to figure out what a decedent's lifetime gifts were. And so we're reviewing gift tax returns in that context. And in the course of all of those reviews, which are a lot of reviews, I've routinely come across issues on gift tax returns. And that's the source of this presentation. The point being, don't undermine your 709. I thought that was catchy. So before we get to the problems that we see on the 709s, let's start with who needs to file a gift tax return to begin with. And the source of that information is in the code, as is much we're going to talk about today, Code Section 6019, which says that there's an obligation for a donor to file a gift tax return if they make any gift other than an annual exclusion gift, a gift that qualifies for the medical or educational exception, a gift for which the marital deduction is allowed under Section 2523, or a gift to charity, but only if the gift to charity is a gift of the donor's entire interest in that property and they haven't previously transferred another interest in that property, or if it's a gift of a conservation easement. If the donor makes any gifts during the year other than one that falls into those limited categories, then there is a return filing obligation. And once that return filing obligation exists, then all gifts made during the year must be reported, even annual exclusion gifts, marital gifts, and charitable gifts. And that's with good reason. So think about this, for example, in this new matter where we were reviewing the decedent's gift tax returns, we were trying to go through all the gift tax returns and make a chart about how much exemption you'd used, how much GST exemption you'd used, and so on. And the son looked at the chart with me and he said, well, this is all fine, but also Dad wrote us all checks every year for the annual exclusion amount. Well, dad didn't tell the CPA that he did that. And so the CPA took annual exclusions off the larger gifts that were reported on the return. So in essence, by not informing the CPA that he'd made separate annual exclusion gifts, he had caused the CPA to double count his annual exclusions in every year. Another place where we see non-compliance is reporting charitable gifts. So a lot of people think, oh, why do I need to report the charitable gifts? They just go on and they come off. But the law does require it. When I look at gift tax returns, I see that the big four accounting firms are the ones who routinely do report charitable gifts. And it's not that hard. You just take the total off the income tax return, put it down as a gift, goes in as a gift, goes out as a deduction, and you've complied with all the rules. So it's a good practice to do that. Even if there isn't a return filing obligation, there are a lot of other good reasons to file a gift tax return. You need to file if you need to make a gift splitting election, you need to make a QTIP election, a QDOT election, if you're making large contributions to a 529 plan and you need to make the 5-year election, if you're making any gifts that impact the generation skipping transfer tax, you might need to allocate exemption, or you might need to make an opt-out election or an opt-in election. You might want to make some disclosures. You might want to get the statute of limitations running. There are a whole host of reasons why it would be a good idea to file gift tax returns, even if it's not technically required. So now let's get to some of the problems that we see with gift tax returns. Starting with annual exclusion gifts. You would think annual exclusion gifts are pretty simple, and yet we see a lot of problems. So Code Section 2503B says that the first $15,000 of gifts, other than gifts of future interests made by any person by the donor during the calendar year, are not included in the total amount of gifts made for the calendar year. So what kind of mistakes do we see? One mistake that comes up frequently is that people take an annual exclusion for gifts in trust that don't qualify for the annual exclusion. Remember, gifts of future interests are not eligible for the annual exclusion. So there are really only two kinds of trusts that can qualify the beneficiary for the beneficiary's annual exclusion. One is a trust that has a crummy power, a withdrawal power, and the other is a 2503C trust, the trust that ends at age 21 that's set up for a child. Other than those two types of trusts, you can't get the beneficiary's annual exclusion through a gift in trust. So that's one common problem. People take the annual exclusion for trusts that don't qualify. A second is that people take an annual exclusion for the trust as if the trust itself was entitled to an annual exclusion. That doesn't work. Only people get annual exclusions. Another mistake I've seen is where, let's say I give $25,000 to one of my children in the year, and I give $10,000 to my other child during the year. So I've made a total of $35,000 of gifts, and I take $30,000 in annual exclusion exceptions. Can't do that. It was 25 and 10. So on the 25, I get a $15,000 exclusion. On the 10, I only get 10, and my total of annual exclusions that year is 25,000 and not 30. Another common misunderstanding is that people don't understand that the GST annual exclusion is different from the gift tax annual exclusion. So the relevant GST provision is in Code Section 2642C. And what it says is that in the case of a direct skip, which is a non-taxable gift, the inclusion ratio shall be 0. A non-taxable gift is one that either qualifies for the annual exclusion or the tuition or medical exception. The GST rule does not give an annual exclusion for a gift in trust unless during the life of the beneficiary, no portion of the trust corpus or income can be distributed to any person other than the beneficiary. And if the trust doesn't terminate before the beneficiary dies, the assets of the trust have to be included in the beneficiary's gross estate. Okay, so a couple of examples of that. If I write a $15,000 check to my grandchild, then that qualifies for the annual exclusion, and that would also get a 0 inclusion ratio under this GST rule. if I set up a trust for a grandchild, one grandchild, and all distributions to that grandchild are discretionary, but can only be made to that one grandchild. And if the grandchild passes away before the trust terminates, the trust assets are distributed to the estate and included in the grandchild's estate. That qualifies for the GST annual exclusion. But if I had 3 grandchildren and I set up one trust for the 3 of them, that trust would not qualify because it doesn't meet the requirement that a trust be for a single individual and included in that individual's estate if they die. So you need to be careful, and you may need to allocate GST exemption to something that qualifies for the annual exclusion if it doesn't also meet the GST annual exclusion rule. The next special rule is for contributions to 529 plans. And there's an election on the return that allows you to use 5 years worth of annual exclusions in advance with a lump sum contribution to a 529 plan. This can be really useful. So to make this election, there's a checkbox there at the top of page 2 of the gift tax return. Check here if you elect under 529 C2B to treat any transfers made this year to a qualified tuition program as ratably made over a 5-year period beginning this year. See instructions, attach explanation. So what kind of explanation do they want? They would like you to include the total amount contributed per individual beneficiary, the total amount from which the election is being made, and the name of the individual who's the beneficiary of the 529 account. Very simple, just have to follow the rules. So for example, let's say that mother contributes $50,000 to a 529 plan for her child. She doesn't make any other gifts to the child that year, and she makes this election. The effect of this election would be that that $50,000 contribution to the 529 plan would be treated as being made ratably over the year in which it was made and the 4 subsequent years. So $50,000 over 5 years, that's going to be treated as a $10,000 gift in each of those 5 years. So that leaves mother with another $5,000 of annual exclusion left. So if she wanted to make some other gifts to that child during the year, she still has a little bit of space left. Let's say, though, that she had put $100,000 into the child's 529 plan for this year. How does that get treated? Well, the most that we can spread over the 5-year period is $15,000 a year. So that would take care of $75,000 of the contribution. The other $25,000 that doesn't get spread over 5 years under this election is treated as a gift in the first year. So in the first year, we would have the $25,000 that the election doesn't apply to, plus $15,000, which is the first year's annual exclusion, a total of $40,000 being treated as a gift in the first year. And then in each subsequent year, $15,000 would be treated as gifts under this 5-year election. If you don't have any other gifts in the years 2 through 5, this election alone doesn't trigger a gift tax filing requirement. But if you make other gifts in years 2 through 5, then you have to include this on the return for the same reason you should include any other annual exclusion gifts, because it helps you keep your records properly. And if the donor dies during this 5-year period, that doesn't allow you to get annual exclusion gifts for years after the year of death. This election terminates in the year that the death occurs. You get that year's annual exclusion, and then subsequent amounts that haven't yet been used are treated as part of the gross estate of the donor. All right. The next thing I want to talk about is gift splitting. Code section 2513 permits spouses to consent to have gifts made by one of them to anyone other than their spouse to be treated as made 1/2 by each of them. In order to qualify for gift splitting, both spouses have to be US citizens or residents. They have to be married at the time of the gift, and they can't be married to anyone else during the remainder of the year. So we're not talking about polygamy here. What we're talking about would be a case where a gift is made while both spouses are alive and married, and then subsequent to that, but still within the same year, they either get divorced or one of the spouses dies. that's okay. You can still gift split as long as you don't marry somebody else before the end of the calendar year. The election is made on the return, on the gift tax return, and it's an all or nothing thing for the year. You either elect to split all gifts made during the year that qualify for splitting, or none of the gifts that are made during the year. So, for example, let's say that father gives each of his 3 kids $100,000 during the year, and mother thinks that's a wonderful idea, and she agrees to gift split. And so when they go to file the gift tax returns, she signs as a consenting spouse, and everything is great. And then later on, there's an examination of this gift tax, or father's gift tax return. And in the course of that, it's discovered that during the same calendar year, father gave $1 million to his mistress. Well, guess what? Mother has now split that $1 million gift to the mistress, because all gifts, even those not disclosed on the return, are split if you elect to gift split for the year. So that's not a happy situation. Looking at the mechanics of a gift splitting election, the election is made by checking the box on line 12, and then the consenting spouse has to sign the donor spouse's return. And if the consenting spouse is dead at the time that the return is filed, then the executor can sign for the deceased spouse. You can make a gift splitting election on a late filed gift tax return, but only if that's the first gift tax return filed for the year. So let's say I wake up tomorrow morning and I realize, oh no, I didn't file a gift tax return in 2015 when I made gifts to my children. And then I prepare that 2015 return now, so it's late. My husband can still consent to split with me, because that's my first 2015 gift tax return that I'm going to be filing. The corollary rule here is that if you elect to gift split before the due date, you can revoke that up until the due date, but not after the due date. So let's say that I file a gift tax return for 2019 in March, and then I wake up on April 14th and think, oh no, I wasn't supposed to gift split because my husband and I were making separate gifts this year because we wanted to use my exemption. I can file an amended return before April 15th or even on April 15th and undo that election. But once April 15th passes, I can't change that gift splitting election. I'm stuck with it. What gets tricky with gift splitting is when gifts to a spouse are involved. The regulations say that the consent to gift split is effective with respect to interest transferred to a third party only insofar as such interest is ascertainable at the time of the gift and hence severable from the interest transferred to the spouse. So let's take an example. Let's say that wife funds a trust with $1 million. Husband has a withdrawal power up to 5% or $5,000 each year. The trust continues for kids when husband dies. And let's just say that the actuarial value of husband's 5 power is $300,000 given his life expectancy and current interest rates. And they're going to gift split. So when husband consents to split that gift, his consent only applies to the $700,000 of value that's ascertainable and not attributable to his 5 power. So when husband splits the $1 million gift into trust, what he's really splitting is only the $700,000 that's going to the kids. So his portion of that gift is $350,000. Wife's portion of that gift is her half of the $700,000 that goes to the kids, so $350,000 there, plus the $300,000 that went to husband. So wife's share of that $1 million gift is $650,000. Now let's change the facts a little bit, and let's say instead of husband's only interest being this 5 withdrawal power, that husband is a discretionary beneficiary for the entire term of the trust. Now the interest of the kids is not ascertainable anymore, and therefore the regulation tells us that husband can't split that gift at all. So even if there's a gift splitting election made on the return, husband can't be deemed to be a transferor of the gift to himself, and we can't split off how much of that $1 million gift is going to him because it's not ascertainable. Therefore, none of that $1 million gift is split. And now, just to make things more complicated, the GST gift splitting rule is not the same as the gift tax splitting rule. So in general, a gift splitting election is respected for GST purposes. But the weird part is that the regulations for GST say that for GST purposes, the gift is treated as made 50-50, regardless of the interest of the electing spouse. So going back to our first example where we put $1 million in trust and husband had a 5 and 5 power, the gift is split such that wife makes a $650,000 gift and husband makes a $350,000 gift. But for GST purposes, that gift would be split 50-50. So the transferor for GST purposes would be $500,000 is deemed to be transferred by the wife and $500,000 is deemed to be transferred by the husband. Now, in the second example, we had $1 million going into trust, but the interest of the children was not ascertainable. Most people reading the GST reg feel that the right answer here is that when the gift, the specific gift, is not split at all, then the 50-50 rule doesn't apply, and that the donor is considered the transferor for GST purposes. So in that example, where we can't ascertain the value of the kid's interests, wife would be the transferor of 100% of what goes into that trust. If you've got a situation where you've got one split for gift tax purposes and a different split for GST purposes, I would suggest that you include an explanation of what you're doing and why with that gift tax return, because I think it's good to set forth in writing what you've done, and it will help eliminate confusion in the future. So I think we need to be particularly careful about gift splitting this year because people are making gifts to try to use up perhaps one spouse's exemption and not the others. In my experience, CPAs seem to check that gift splitting box by reflex, and everybody involved in planning this year, the lawyers, the accountants, the financial planners, the trust officers, everybody ought to be looking at those gift splitting elections this year to make sure that we really do want a gift split this year, or did we actually not want a gift split this year? All right, let's go to lifetime QTIP elections. So lifetime QTIP elections are the saddest area of mistake that I know, because once a mistake is made in this area, they're irreparable under current law. So you can make a QTIP election for a lifetime trust under section 2523F, just like you can make a QTIP election on the estate tax return at death. But for some reason, when those two code sections were drafted, they were drafted differently, such that the IRS has said that the time prescribed for making the QTIP election on an estate tax return is not prescribed by statute. And the deadline for making the QTIP election for a lifetime QTIP election on the gift tax return is prescribed for statute. And that difference actually makes a big difference, because under section 9100, you can get relief for elections that the deadline for which are not prescribed by statute. But if the deadline is prescribed by statute, there's only a 6-month window in which you might be able to make a late election. So what happens here is people create a lifetime QTIP trust, and in their mind, they think that that automatically qualifies for the marital deduction. And either they don't file a gift tax return at all, or they prepare a gift tax return but think, well, that's a marital gift, I don't have to put it on there. Well, those are fatal flaws, because you have to make the QTIP election on the timely filed gift tax return. And if you don't, there's no 9100 relief available, and you just turn something that should have qualified for a marital deduction into something that doesn't qualify for a marital deduction and either uses up exemption or causes there to be gift tax that needs to be paid. So this is such a big problem that I don't even like to do lifetime QTIPs, because I've seen too many of these mistakes and they're fatal. So if you are a person who uses lifetime QTIP trusts in your practice, you got to tell everybody in advance that a gift tax return needs to be filed, a QTIP election needs to be made. I would put it in writing. I would write letters to everybody, because in the end, when somebody fails to make that election, all of the professionals involved are going to be on the line and they're going to try to make you responsible for the mistake. So cover yourself, tell everybody the election has to be made, tell everybody the gift tax return has to be filed, and then try to make sure it really happens, because the best way to protect against a lawsuit in these cases is to actually make the QTIP election. All right, moving on to reporting when there's a valuation discount. So there's an easy to overlook little checkbox at the top of page 2 of the gift tax return, and it says, does the value of any item listed on Schedule A reflect any valuation discount? If yes, check here and attach an explanation. So, there's a joke that this is the audit me box, but it really isn't an audit me box. But if you have any items on which a valuation discount is being used, then check the box. A valuation discount in this context could be lack of marketability, could be minority discount, a fractional interest discount, blockage, market absorption, anything that doesn't reflect the value of the underlying assets would be a valuation discount in this context. Now, as for the explanation, generally speaking, you're going to be attaching an appraisal to support this discount in any event, and your appraisal ought to contain all the information that's necessary. So usually you don't have to do anything special other than check this box and attach your appraisal, which is a nice segue into adequate disclosure. Since 1997, the change in law that occurred in 1997, the statute of limitations on gifts runs on a gift-by-gift basis. In other words, you don't get the statute running on the whole year by filing a gift tax return for some gift during the year. You have to actually disclose the particular gift in a manner adequately to apprise the secretary of the nature of the gift. So if you make adequate disclosure, then the statute of limitations on that gift will run in 3 years absent fraud. So obviously, adequate disclosure would be desirable. Let's look at what's involved in making adequate disclosure. The adequate disclosure regulations give a safe harbor for disclosure, and it sets forth the requirements very carefully. Many are very basic, like identify the transferred property, identify the transferee and the relationship between the donor and the recipient. If the transfer is in trust, you have to identify the trust, report its taxpayer identification number, and attach a copy of the trust instrument. The key requirements that get people hung up are in Romanet 4 of the regulation. And that is where, in very detailed order, the IRS has set forth all the requirements that would satisfy the adequate disclosure regulations for different sorts of transfers. In lieu of providing this detailed information, you can also provide a full appraisal that satisfies the appraisal requirements that are in the regulations. So my suggestion is that you use the regulations as a checklist. You put them over here on your desk and put your appraisal or your other information over there on your desk and literally go through them one by one and make sure that you have included everything that the regulations say that you need to include given the type of property that you've made a transfer of. So we're hearing reports that the IRS is exploiting the lack of adequate disclosure to audit gifts after a donor dies. Well, I do think that they, in fact, do this. In fact, I know they do this, but I don't think it's something nefarious that they're doing. They're actually doing exactly what Congress had in mind when they changed the law here. And that is because the IRS doesn't really have the resources to audit every single gift tax return that's filed. And a lot of gift tax returns are filed for people who will never file an estate tax return because they'll never have a taxable estate. So what the IRS will do is when an estate tax return is filed and they're reviewing that return in any event, if there's an indication that there have been lifetime gifts, at that point, they'll pull the gift tax returns and look at them. And then if there are issues on those returns, and if those gifts are not adequately disclosed, then the IRS can go back after the donor has died and audit those gifts, even if they're 10 years old or 20 years old. So the one thing we have seen in the couple of reported events that we've got is that when the IRS latches on to something on a gift tax return that they think is wrong, they will exploit foot faults to try to be able to assess gift tax even 3 years after the return was filed. So there's a field service advisory that's out there where the taxpayer's foot fault was they left one digit out of the EIN of the family limited partnership to which of which interests were transferred. And the IRS says, well, then that's not adequate to apprise us of the nature of the gift because you didn't give us the full EIN. And if we wanted to then, pull the tax records of that entity and look at it to see if everything jives with what you said, we're not able to do that because you didn't give us the full EIN. So little things like that can cause major problems. And the solution to that problem is proofread your gift tax returns. Make sure you've got everything that's required and make sure that all the information is accurate. Another question that comes up in terms of adequate disclosure is whether we should disclose things when our position is that it's not a gift. And the regulations do allow the disclosure of non-gifts as a means of getting the statute of limitations running. So you might disclose a transfer to a family member and say, but it's not a gift because the family member paid me full and adequate consideration for it. Or it's not a gift because the family member was employed in my company and this was their salary. You can make that kind of disclosure and get the statute of limitations running on that issue. The question is, should you? And that's a question on which people disagree. It's really a trade-off. The question is, by highlighting the non-gift, you might increase the chance of that being audited. On the other hand, by reporting the non-gift, you have a chance at getting certainty. So given the low audit rate of gift tax returns, and it is very low, under 1% of gift tax returns filed in each of the last 10 years has been pulled for audit, a lot of people do opt for reporting non-gifts because they think that it doesn't really increase the chance of examination by very much. Others just don't want to report anything that they don't have to report. Most people will report the full transaction, the gift and non-gift part, if what they're doing is gifting seed money to a trust and then following that up with a sale. They will report both the gift of the seed money and the sale on the assumption that it's really kind of one integrated transaction. And if you're already reporting the one gift, you might as well report the whole thing and try to get the statute running on the entire transaction. So again, it's a judgment call, but you should at least consider whether the gift should be reported. Another hot issue is how to report gifts that are subject to a defined value clause. So after a rocky start in life, defined value clauses have surged in use since the taxpayer favorable decision in Wandry. And even the not entirely good outcome in Nelson still, I think, supports the idea that defined value clauses are viable. So in these clauses, often a gift is described in terms of its value. So a gift of $1 million worth of interest in XYZ LLC rather than a gift of a 10% interest in XYZ LLC. The key here is to report on the gift tax return consistently with how your documents report the actual gift that's made. So if your documents say, I am gifting $1 million worth of LLC interests, don't report that as 100 units of LLC interest on your gift tax return. Report it as $1 million worth of LLC units, and you can footnote that or whatever you want to do to say, based on our appraisal, we believe that to be 100 units, but that will adjust it. The amount of units transferred will adjust itself if on final determination, it's concluded that that $1 million worth of units is not 100. So if you need to attach an explanation, make adequate disclosure to apprise the secretary of the nature of such item. And then if you sail through and don't have that examined, you'll have closure at the end of 3 years. So let's get into some of the nitty-gritty now. The real nuts and bolts of properly completing the gift tax return, and we see a lot of mistakes in this area. So if we start with Schedule A, which was too big to put on a slide, so you just have to imagine that you're looking at a Schedule A right now, it's divided into 3 parts. The first part is gifts subject only to gift tax. Part 2 is direct skips. Part 3, indirect skips and other transfers and trust. And the 3 groupings here are important to help the preparer fill out the rest of the return correctly. So it bears looking at these in more detail. So let's look at the way that we should be assigning gifts to Part 1, Part 2, or Part 3 on the gift tax return for Schedule A. The only gifts that go into Part 1 are gifts that cannot possibly be subject to GST now or ever. So examples would be an outright gift to a child, a gift in trust for a child where the child's got a general power of appointment, or a gift to charity. None of those things could ever have GST apply to them. They go in Part 1. In Part 2, the form asks for direct skips. And here it's using the GST definition of direct skip. So possible examples of that would be an outright gift to a grandchild. That's a direct skip for GST purposes. Or a gift in trust, and the trust itself is a skip person. That would be a direct skip. The third part is titled Indirect Skips and Other Transfers in Trusts. So this is confusing, I think, because indirect skips is a defined term under the GST, and yet as used in Part 3 here, they don't mean it in the sense of the defined term. So we have direct skips, which is a GST concept that we're using, and indirect skips, which is also a GST concept, which we're not using in Part 3. Part 3 here serves as a catch-all provision. So if it's not a gift subject only to gift tax and it's not a direct skip, then it goes into indirect skips, Part 3. The kinds of errors we see in this misclassification include indicating that a gift to a person who is a trust beneficiary, indicating that a gift is a gift to the beneficiary rather than a gift to the trust. That's very common. Putting all gifts to trust in Part 2, even when they're not direct skips. And the idea that trusts that you're not going to allocate GST exemption to should go in Part 1, when in fact they should go in Part 3. So what ends up happening is that Schedule A has this column C, and column C is just a troublemaker because column C is used for different purposes in Part 1, Part 2, and Part 3. So in Part 1, where it's gift subject only to gift taxes, column C is just blacked out, it's irrelevant. Okay, that's not so hard to make a mistake with that. In Part 2, column C asks the question, do you want to make an election under 2632B to opt out of automatic allocation of GST exemption to a direct skip? And notably, that's something you would rarely want to do. But there, because it's a direct skip, you've got automatic allocation of GST exemption, and your checkbox there is an opt-out. In part 3, where we're dealing with indirect skips and all other transfers, the question on column C is, do you want to make any of the 2632C elections concerning allocation of GST exemption? Well, that's a loaded question because there isn't just one election under 2632C. There are actually about 5 different elections you can make. You can elect out of automatic allocation to a GST trust for that transfer. You can elect out of automatic allocation to a current transfer or all future transfers for a GST trust. Or you can elect to treat any trust as a GST trust for purposes of just the gift being reported on this return, or for purposes of all gifts that you make forevermore to that trust. So by my count, that's about 5 different things that you could be doing there, some of which mean GST exemption gets allocated, and some of which mean GST exemption doesn't get allocated. And to top that, if you've got in part 3, a gift that really should have been in part 2, and then you check the box, what does that even mean? Because the column C election for part 2 isn't even relevant to something that would go in part 3. So it's a mess. You got to be really careful. And it all goes back to getting those gifts compartmentalized and classified correctly when you fill out part A. So in the 2632C elections, those are the ones that could apply to an indirect skip or other transfer. The instructions say, attach a statement to Form 709 that describes the election you're making and clearly identifies the trusts and/or transfers to which the election applies. Well, obviously you have to do that because we've got one checkbox that could mean you're making any of a number of different elections. So you need to attach a statement. Anytime you put a check in that column C under part 3, you have to attach a statement that explains which election you're making and what it applies to. So fortunately, unlike the sad QTIP election, if you fail to make an election in the GST arena, you can get 9100 relief. So at least you've got a safety valve there, although 9100 relief is expensive. If it's a really big mistake, it's well worth doing. And the IRS has been very good about allowing people to make late retroactive elections in appropriate circumstances when they satisfy the requirements for 9100 relief. If your error goes in the other direction, where you make an election when you didn't mean to, there isn't 9100 relief for that. 9100 relief only lets you make a late election. It doesn't let you unwind an election that you didn't mean to make. So in the gift tax return, we have 2 recapitulations. The one that's on the screen right now is the recapitulation for gifts. And what you're supposed to do here is, because the gift tax is a cumulative tax where we have to keep track of how much of a person's applicable credit amount they've used, you list each year's return and how much exemption was allocated and how many taxable gifts were made. This is an area where we see a lot of mistakes, where people just leave off some of the prior gift tax returns. Somebody changes accountants and the new accountant isn't aware of old gift tax returns. So my thought on this is, if you're looking at this recapitulation on a return that's already been filed, just take it with a grain of salt, ask a few questions, see if this really reflects all the gifts that have been made, because otherwise it can mislead you into thinking that there's more exemption remaining than really is remaining. Another complication that arises is when a taxpayer has inherited DSU from a predeceased spouse. Again, this is an area where the form is trying to help us do things properly. So it asks you to fill in the amount of DSU received And then it guides you through using that DSU first, which is what the code and the regulations say that you have to do. And I think this is especially important in 2020, when a lot of clients are trying to use their bonus exemption, the part of the exemption that they're afraid is going to go away. Well, I think we've all learned the basic rule that to get to your bonus exemption up here, you have to first give away your basic exemption and then give away your bonus exemption. But if it's a taxpayer that's also got DSU, the bottom block in the stack is the DSU. So let's say a client's husband died last year and she inherited a little more than let's just say $10 million of exemption. If she starts making gifts, she's going to use that DSU first. If she makes $10 million of gifts, the next chunk she gets to is her own basic exclusion, of which she might have as much as 5.79 million remaining. And she has to make all of those gifts. And the next block in the stack is what I call the bonus exclusion, the part that is supposed to go away at the beginning of 2026. Only after she's gifted her way through all of her DSU, all of her basic exclusion, does she get to the bonus exclusion. So if you're doing gift planning for a widowed person, you need to know whether they inherited DSU or not, or you won't know which exemption portion you're using and whether you're really doing any good at locking in the enhanced exemption this year or not. The other reconciliation page is the GST reconciliation part of the gift tax return. And this is a lot like keeping track of the use of a person's estate and gift tax exemption, although this is even trickier because we've got a set of very helpful automatic allocation rules, and that's great. That's helped really cut down on the number of mistakes that are made on allocation questions. But what tends to happen is if somebody has gotten the advantage of automatic allocation when they didn't know they needed it, they probably didn't put that number into the GST reconciliation page either. So again, if you're taking over a representation or you're the new CPA or you're the new advisor and you're looking at this GST reconciliation page in the most recently filed gift tax return, it might not be right. There are tons of mistakes that we see here. So ask questions about it. Check for automatic allocations that never were reported on the gift tax return. Check for other errors. I've seen all kinds of unbelievable mistakes on this schedule where people put in that they've used more exemption than they actually had used. They put in 0 when they already used some. I saw one recently where it was a year when the GST exemption was 5,120,000 and the CPA reported that the amount claimed on this return was 5,700,000. And then I guess he didn't feel good about putting a negative number down there on exemption available for future transfers, so he just left it blank. And then the next year, he still showed 5,700,000 having already been used, even though even in the next year, the taxpayer didn't have that much GST exemption. So errors abound. Be careful. Try to fill yours out properly. Question anything you see on somebody else's prepared return. The last topic I want to touch on is gifts by non-resident non-citizens. So there are special considerations when you're filling out a gift tax return for a non-resident non-citizen, because unlike the estate tax return, which has the special 706 NA form, there is no 709 NA. So the non-citizen non-resident is filling out the same form, but only reporting gifts of US situs property. In this context, US situs property basically means US situs real property and tangible property that's got a US situs. So you just need to be careful with this. Only report the gifts that are required to be reported. You don't want to report as taxable gifts that are not actually subject to US gift taxes. So my final words of advice are, when in doubt, read. Reading is good. Read the code. read the regulations, read the instructions. They're all really helpful. And try to avoid undermining your 709. So Matt, it looks like we probably have some questions.
We do. Beth, great presentation and thank you. We have a couple of questions that are quite a few questions actually that have come in. I'll pull them up here and I'll start at the top and we'll see how many we can get through. Any that we don't get through, we will respond. We'll just have to do so after our time here. So the first question, Beth, is on gift splitting. If one of the spouses made a gift that is ineligible for splitting, they can still split all other gifts to third persons in the year they're eligible for splitting?
True. That's
so I'll read that back. If one of the spouses made a gift that is ineligible.
Yes. So let's flesh that question out a little bit. So let's say that spouses made gifts to children, grandchildren, whoever, and there's also a gift that's ineligible for splitting because it's a trust in which one spouse has an interest and also other people have an interest, and they're not sufficiently defined that we can ascertain the value of the gifts to third parties. So that gift would not be splittable, but they can still make a gift splitting election and split all of their other gifts. Great. Is that clear? Okay.
I believe so. All right. So this came fairly early in your presentation when you were talking about gift tax returns specifically. You had some references to 2015. And the question is, what if my spouse already filed a 2015 gift tax return?
What if your spouse already filed a 2015 gift tax return, but you didn't? I do not think you could make a gift splitting in that circumstance, because gift splitting is reciprocal and your spouse at that point would be precluded from having you gift split if you hadn't already. And so I don't think you could make a gift splitting election late in 2020.
Understood. Do you think that the Democrats' idea of limiting a donor's annual exclusion gifts to a total of $50,000 or some lower amount to all donees will become law? Wouldn't this cause a huge outcry?
Yes, so there are a number of legislative proposals floating around to alter the laws concerning annual exclusions. One is to limit the number of annual exclusions that a person can use each year. Another is to limit the use of annual exclusions for gifts in trust. In other words, to further, the idea being that crummy withdrawal rights are really fictions and we shouldn't give annual exclusions for those. I think that would be the quick way of explaining that. Obviously, I don't have a crystal ball, but I think that the attempts to limit annual exclusions to actual individuals would not be a popular idea, because to me, it seems to penalize large families over small families. Because if one of the proposals is you only get 2 annual exclusions a year. Okay, which of my 3 kids should I give gifts to? I guess I would alternate years or something. I just think that that's a little far-fetched. The things that I think would be more likely to crop up would be crack down on use of annual exclusions other than for outright gifts. I think that would be more possible.
Understood. Next question, with respect to adequate disclosure for gifts to qualifying trusts, the regulations don't expressly require a certified copy of the trust to be attached to the Form 709, but the instructions seem to imply that a copy be included when initial gifts are made, followed by a description of the trust for subsequent gifts. Given the high stakes, are you recommending taxpayers attach a copy of the trust on the Form 709 included in the initial gift?
Yes.
Great. Simple answer. Next question. For direct skips, would you elect out of automatic allocation if the gift qualifies for the GST annual exclusion outright to a grandchild?
No, you don't elect out, but you do, there's a part of Schedule D where you list the total amount of the gift, and then it asks you how much of that qualified for the gift tax annual, the GST annual exclusion. So that's where you would subtract the up to 15,000. And if it's, let's say it was a $15,000 gift to a grandchild, then you subtract the 15, then you have 0, and then you're done. You don't actually opt out. You just get a 0 inclusion ratio automatically. I'm not sure if that made sense, but I would not opt out.
Thank you. Next question is, I've been doing some planning with a client for a large gift and reviewing prior year gift tax returns. Noticed that the CPA seems to have incorrectly not reflected gifts that should have used GST exemption. Also, for some years, gift tax returns were not even filed for years in which they should have been. As a result, I do not think the current remaining GST exemption as reflected on the last gift return is accurate. These errors occurred between 09 and 17. Should or can we even file corrected gift tax returns for the old years to correct this and come up with an accurate remaining GST exemption?
Yeah, I mean, that pretty much summarizes the entire presentation today, because that is such a common occurrence where there are mistakes. And I think I'm going to take this question as meaning, okay, we know there are mistakes, what should we do to fix them? And I think the answer to that question is going to turn in part on what kinds of gifts they are, meaning were they cash gifts, were they hard to value assets, and so on. So if the gifts for which no returns were filed were cash, that's easy enough, or marketable securities, or anything that's easy to value, I would go ahead and prepare late returns and file them. And then on your next return, update all those reconciliation pages to appropriately show all the actual gifts that were made and the actual GST exemption that was used. I think that's easy. And if you do go ahead and file the back returns, you're not running a huge risk because your gifts are all readily substantiated. There aren't questions of value. You're unlikely to draw an audit. And then you've cleaned everything up so that whoever comes along after you has got a good and accurate record of the gifts that were made, and future mistakes won't be made. Now, even with hard to value gifts, well, hang on, before I go there, I have sometimes not filed amended returns, but just reflected the additional use of GST exemption in the reconciliation form. And when I've done that, I've generally put in an explanation so that someone looking at last year's return and this year's return can readily see why the numbers are different. And just an explanation like, taxpayer discovered that there were unreported gifts in the amount of $100,000 in 2015 that were gifts to a GST trust and therefore attracted automatic allocation of GST exemption. That allocation is reflected in this reconciliation. Done. Okay, you've explained why this return looks different from the last one. All right, so now if you've got hard to value assets that your client made gifts of and didn't report, then you've got the possibility that if you report them now, you will trigger an audit. But if you don't report them now, then the statute of limitations on those gifts will never run. You don't have an obligation to file a late return, but it still may be the best course of action. So I would put that in the category of judgment calls, but often the better judgment will be to go ahead and prepare and file those returns so that there's a complete record. You've got the information at hand now. If the client dies 30 years from now, you may not even be able to find the relevant information to put your case together. And I think that often the best course would be to go ahead and correct all those back returns and make the record proper.
Beth, really appreciate it. I think we've probably used up our time for questions today, but as we said, we will send the recording of this and all the materials out to anyone who registered for review and perusal later. And also any questions that we didn't get to, we will get you a response after today's presentation. Beth, any parting words?
No, be careful. October 15th is coming.
Thank you, everyone. Beth, thank you for the great presentation. And we look forward to partnering with you again soon on more content.
Thanks.
Take care.